Hi, welcome back. This is Paul Chan from DLBS. Let's begin our next video together. Welcome everyone to our 8th video. Today we will be talking about a couple of strategies. Both are within the bullish spread family. So let's get started. Here's the agenda we have. We are going to do a quick recap of what we talked about in videos 4, 5, 6, and 7 about how to buy and sell calls and puts. All of those we've shown so far are single-legged strategies. Now we will graduate to the next level and start putting two of these together to make a spread. This video will specifically talk about bullish spreads where we are anticipating a stock price rise. The next video, video 9, will talk about bearish spreads. And we will talk about two of these specific ones. One strategy is called the bull call and another one is called the bull put. We will compare these two together, recap of our golden rules, then we'll show you some examples of how to execute these trades using our Loblaws, which is the largest supermarket chain in Canada. We will recap all the free tools we showed you as well as how to get options play for you. So let's get started. If you recall, the very first technique we showed you was the most basic, called the buying a call option. And there was always a buyer and a seller. In that case, you would be the buyer and a market maker will find you a seller who sells you the call option and you pay some premium. Video 5 talked about how to sell call options, either naked if you don't have the shares, or if you have 100 shares for every contract, it's a covered call. And again, now this time you're on the selling side and somebody actually wanted the contract that you are willing to write, and they will pay you a premium, of which the next day you will see that money right in your account. Video 6, we talked about how to buy a put option. So here again, you're the buyer. You want to buy the right to sell somebody something, and you're willing to pay a premium for it. And video 7 talked about selling put options, either a naked put or a protective put if you own the shares. And again, you are now the seller again, selling an obligation to somebody and collect premium. So all of these were single-legged trades, of which you can use these either buying a call or selling a put whenever you anticipate the stock to increase in price, or buying the put and selling a call when you anticipate the price to fall. We could also use these when the stock is not moving up or down, but I would not suggest it. There are much more efficient and better strategies for that, which we will show in a subsequent video. So let's graduate now to a spread scenario where we are taking a directional trade on the upside, expecting a stock price to rise based on technical and fundamentals. We are doing the basic thing as we did in video 4. We are buying a call option at the strike price, so at the money. But at the same time, we will add to that a call option that we will sell a little bit further out of the money, and both will have the same expiration date, so it's called a spread. So the mechanics is basically buying a call option of which it costs us money, has a nice healthy delta around a half. And remember, time decay works against you when you buy something. At the same time, I'm selling a call option to subsidize my cost because I will collect some money for the call option that is further out of the money, but the money will be less than what I'm paying for at the money. It has a lower delta because it's farther out of the money, and time decay works in my favor, so I can offset the time decay of what I sold. The net effect of these two is still my cash flow will be outgoing, but not as great as just buying the call option by itself. So at the end of the day, it's still called a debit spread because it still costs me some money, although less. Here's an example using a stock XYZ trading at $72. I may buy a 3-month 72 call at $5.70. And if I just did this is just a basic call option purchase as we shown in video 4. But now we get interesting. We're going to sell something we don't have, which is a 3-month $80 call and generate $2.60 in income, thereby reducing my net cost of this trade down to $3.10. And when you look at it visually, basically here we are buying a 72 strike price at the money for $5.70, collecting $2.60 for an $80 call sold further out of the money. The net cost is $3.10 going out, so it's a debit spread. And here's how the mathematics work out in the table. And if you notice in the second column, for profit and loss for the 72 call bought shown in red, no matter how bad things get with the price going the opposite direction, the worst I can lose is my entire premium, which is $5.70 per share. 100 shares in one contract, that's where the $570 comes from. But if I'm right, I capture a lot of upside as the price goes up. Flip side though, I also sold an $80 call. And if you see in the third column shown in green for profit and loss for $80 call sold, the most income I could possibly generate is $2.60 because I sold it at a fixed premium negotiated based on a strike and expiration I chose. But I do have obligations, and if this price did exceed $80, you'll notice I could be losing $240 or $740. So the two combined together gives me a position where my net spread profit shown in right hand side in the yellow column, the worst case scenario is I could lose the entire spread, which is $310, which is a better position than just buying a call because my maximum loss would be $570. But the trade-off is, on the best case scenario, I can never make more than $490. So it's a compromise. And this is the chart that shows you the upside is capped based on the $80 strike price I sold. But the downside is also limited because there's additional income reducing my break even. So if you anticipate a larger movement, then buy the call option. But if you anticipate smaller movements, the bull call spread is a much more efficient mechanism to do so. And if you need longer time frame to reach your target price, you do need a call option. But if it's a smaller time frame that you need, then a bull call spread would be a better choice. And if you take everything I showed you in the last 5 minutes and flip it upside down, then we have the bull put spread. Again, this is the same thing. I'm taking a directional trade, expecting the share price to rise. And this time, I will be selling a put option, not quite at the strike price, but probably just a little bit out of the money. And I will do the same thing. I will buy a put option with the strike price even further out of the money, so the price is even lower. They both share the same expiration. So when I sell a put option at or near the money, I receive money. There's a nice healthy 0.5 delta, but time decay works in my favor. I want this to expire worthless. And I will compromise this with buying a put option further out of the money, which costs me some money but less because it's further away. There's a lower delta there, and the time decay works against me. And when you take these two together, the money I received from the put sold is greater than the cost to buy the even further out of the money put option. Thereby, I'm generating income coming in. I'm not spending any money. So this is known as a credit spread. So here's an example again, XYZ company at 72. I'm going to be selling a 1 month $70 put for $2. And I will buy back that put for $1 at 65 strike price, so even further away. The net credit is $1 coming into my pocket. I will see this in my account the next day. So again, here's the 70, buying the 65, and my net $1 income is a credit spread. And when we put all of this together, again, the same table shows for the profit and loss for what I've sold at $70 put, the most I could ever generate is $200 in income because it is a predefined premium I collected for the obligation sold. but I do have downside risk. If it drops to even $60, I could be down $800 if I guess the wrong way. Now this is complemented by the profit and loss at $65 put bought in red. The most it ever cost me is the $1, so $100, but I could capture gains from the put option. So you can see there's $400 of gains if it drops to $60 and so forth. The net spread profit shown in yellow on the right hand side shows the worst case scenario I could do is losing $400. But the best case scenario I could do here is $100. So it's a compromise, it's something to help complement your strategy with the bull call spread. And as you can see, my upside is capped and my downside is capped. And when you compare these two again, the longer time frame you need, then sell the put option. If you think you can be more precise, shorter time frame required, then the bull put spread is worth considering. If you have margin room considerations, selling a put option is something that you do need to worry about. Whereas using the bull put spread, you are using the put that you purchase further out of the money to complement and offset some of the margin requirements that you need. And when you compare these two spreads together, you will see the bull call, it's a little bit more aggressive. Takes a more trade of a direction, whereas the bull put spread, it's a more conservative of a cash flow generator. Time decay works against you in the bull call, whereas it works for you in the bull put. And the risk reward ratios are rather different. So you have two very wonderful strategies in your arsenal to complement what you've already learned in videos 4, 5, 6, and 7. So the golden rules to remember: buy into weakness, sell out of strength. Sounds easy, but you need to remove the emotions out of it. So you need to know what is your entry and exit points. Preset your sell orders the day after you've purchased these contracts. And never invest more than 5% of your capital in any one trade. So when we shop for these bullish spread candidates, I'm looking for typically a long-term rise pattern. I ideally want to get in when there's a low RSI showing it's an oversold scenario, so it has an upward swing. And I want to get out when the RSI hits the next peak, when it's overbought. And we will again use Canadian equities, which gives you a diversification from the US dollar. It's a nice, safe political climate, stable economy, nice bid and ask spreads for Canadian stocks. BlackBerry, Royal Bank, Shopify, these are some of the names that you may know. Even though we use Canadian equities in our examples, the techniques and strategies are uniform and usable around the world. So here's the chart for Loblaws, and you will see historically it's been a rather stable share price between these two arrows. And suddenly something happened on November 1st that caused it to drop $10. Something that hasn't happened in a whole year. In fact, hasn't happened before in its history. Then it stabilized back about $59, so halfway point. So we've got some confirmation of a support level, a new support level that has broken. And you notice the RSI is very low and it has hit low points before. And every time it does come back. And if I magnify to the 1 week, I do see some support and it's starting to rise nicely. So I'm not so concerned about finding a new support level. And let's do a little bit of fundamental analysis to find out what happened. What caused the $10 drop in the stock? And I find there's a one-time tax charge. And on November 1, there was also a spin out of the property division. So the stock market did not like that either. That explained the huge drop. Let's get a second opinion from Financial. And the seasonal, based on 3 years of statistics, is still forecasting to rise back up to $65 plus. So we will go to our options chain. I see there are 5 expiration dates. each with multiple strike prices to choose from. So how do I decide which expiration go with? Which strike price to go with? They all look the same. And remember, calls are on the left, puts are on the right. So we have hundreds of choices. It's much more complicated. So let's get options play to help us. I see a technical score of 5, so it's rather neutral. And if I select a bullish, I've got a call spread vertical on the right. And it defaulted to the most optimal that the computer found with a December 21 strike price, buying at 58 and selling at 62. And if I use my simulator down here, I can simulate what if the price goes to different prices. So instead of 158 generating 227 in profit, it would vary if it did not hit the price that I forecasted to. And this simulator will tell you, but if you notice, no matter how high it goes, your profit is capped at 242 because you've sold the 62 call. Now, also interesting is the date. If you notice, I don't necessarily need to hit it too early. In fact, the later, the better, and that's because of the call option I've sold and the effect of time decay working for me to offset. Likewise, for the bull put strategy is also called a short put, and here is selected a January 18. I'm not comfortable with a $60 sell. It's a little bit in the money. I would like to get out of it, so I'm going to go to 58. And I'm going to compare 58 with a 56 sell. That's got a 85, 90, 96 score. I'm much more comfortable with selling a 58 and buying a 52 put vertical. And if I go to my simulator and vary the prices, you notice my $93 profit is capped, which is income that I collected. And my time variance also varies. So there's no way we could possibly calculate all of these by looking at the options chain alone. So let's go execute these trades. December 21, call on the left hand side, selecting the 58, and I'm going to select my vertical. And here I have I'm buying a 58, I'm selling a 62. Here the cost is 168 and taking in $10. There's the bid and ask spreads. And I'm not all that desperate, so I don't necessarily even want to go to the midpoint. I will go to $1.30, just a little bit higher than the last bid. And this is a debit because it cost me money. And I'm willing to pay $1.30 for this, for a December 21 58, selling a 62 of the same date. Now for the bull put strategy, I will go with the January 19, that options play selected, and remember puts are on the right hand side, so I go down to my vertical, and I'm not going to be buying. I'm going to start with a sell, January 19 at 58, but again, remember you got to select the put. This is a very common mistake. And I'm going to be doing a 52 for the sell, and if you notice here, I'm generating 118 in income and spending 25. So here's the bid and ask, and I will go with something not halfway in between. I'm not that desperate, so I'm willing to get in ahead of line of the other gentleman. So $1.10 is what I would like to sell this for. So it's a credit. I would take in $1.10, which is a better offer than the next ask at $1.15. And this is how we enter a bull call and a bull put spread. So here's a summary of all the free tools we've shown you multiple times. Wonderful strategies and information that are available in numerous sites on the internet. All of these cost you nothing. So please take your time and go through each of these. And remember, sign up for Options Play. For Canadian equities, is right at this link. It's no charge. It's a permanent license. But for US equities, It's a separate platform. You can register for a 1-month free trial at either of these sites. So remember, keep learning. Continue your journey with us. Learn, practice, and repeat. Tell your friends. Subscribe to our updates and trade ideas right on our website. And try our mentoring services in our marketplace. Welcome back. I hope you enjoyed that video and found it useful. Please remember to rewind, practice, repeat. And if you found it useful, please share it with your friends and family. See you in the next video.